I'm excited to tell you about our sponsor today, Opto Investments, a company that I am an advisor to. More than 85% of companies with revenue over $100 million are privately held, and you can access some of them, but there are huge challenges operationally to building, managing, and maintaining a private markets program. That's what Opto Investments was created to do. Ben and I sat down with Jacob Miller, Opto's co-founder, recently on the Animal Spirits podcast to talk about how Opto is different from some of the other big players in the space in terms of building a fiduciary-first approach with their technology and partnership with RIAs. If you want to learn more, visit optoinvest.com. That's optoinvest.com.
Hey everyone, welcome to The Unlock. My name is Downtown Josh Brown. I'm here with my co-host Michael Batnick, and we are talking today with Rick Edelman. Rick is the founder of Edelman Financial Engines, an RIA with about $290 billion in AUM. Rick is also a New York Times best-selling author. He hosts the Truth About Your Future podcast and is the founder of the Digital Assets Council of Financial Professionals, which is an educational platform for establishing expertise on blockchain, digital technology, and digital assets. That's a really big bio. I need to take a
shorten that.
Okay. Anyway, you guys put out a survey in March about the use of digital assets among financial advisors.
Yeah.
And I want to just pull out a couple of stats to set the scene, because what we're going to talk about today is the practical application of Bitcoin and digital assets in client portfolios. More than 1/3, 35% of the financial advisors that you surveyed said they plan to recommend digital assets to their clients in the next 6 months. That is a 70% increase over the 1/5 of advisors who said the same thing when surveyed in December.
Right.
I wonder if the ETFs had something to do with that.
You think? And that's real. And even the fact that this survey was sponsored by Franklin Templeton.
Yes.
$1.3 trillion asset manager. Why would they want to help us produce a survey about crypto? Well, they're one of the folks that offer one of the crypto ETFs.
That's right.
And the fact that you have these titans on Wall Street now, Josh, Fidelity, Blackrock, Invesco, Franklin Templeton, all launching these ETFs is showing us that it's gone mainstream, and they are incredibly excited about it. And you're exactly right. We did the December survey, no ETF.
Right.
20% of advisors said they were interested.
Yeah.
Now, a few months later, the ETFs are out there, and advisors are falling over themselves, scrambling
and the
to do
price
this.
doubled, both.
Oh, it's nothing like a bull market to get excitement.
Rick, there was a lot of
agree.
debate in terms of the money flowing in, flooding in to these ETFs. Where was it coming from? And this is serendipitous timing that we have you here. I think it's May 15th. This is when the 13Fs, is that what, is today May 15th?
Yeah.
So we found out this morning that Blackrock's ETF, Eric Balchunas tweeted, they had 414 advisors file a 13F, which means that they hold at least $100 million in this thing.
Right.
That is record smashing.
It's astonishing. We already knew that this was the record-setting ETF inflows in the industry, billions, tens of billions of dollars in just the first 30 days and then the first quarter. And now we're seeing the 13Fs. The state of Wisconsin's pension fund, more than $100 million invested in this. We're seeing this across the board. Institutions are now disclosing to their documents. Well, I think it is admitting, because some of them are still doing it quietly under the radar because it remains controversial. They don't want to create heat for themselves or interfere with their job prospects. So some of them are now being forced to admit that they're fans of Bitcoin. They believe it belongs in a diversified portfolio. It's exciting.
So I consider you to be the most influential person in the financial advisor community who is an advocate for the inclusion of digital assets in client portfolios. There's a lot of people in our industry that acknowledge the existence of Bitcoin. They might even know a few things. You have been pounding the table that this is an advisor issue. Even during the darkest times, I remember sitting with you in Austin in 22 when it looked like if you even said the word Bitcoin, you might be arrested. Okay, we've gotten past that point. I wanted to ask you about the Blackrock moment, which is what I think we've just gone through. Is the Blackrock moment the thing where they filed and said, actually, we want to do a Bitcoin ETF? Was that it? Like, when we look back, is that the moon landing for this asset class as an advisory topic?
No, but it's very, very close.
Okay.
It was about a year ago that BlackRock filed for its Bitcoin application, and we were all shocked. thrilled.
You had no heads up. You were
No
shocked?
heads up.
Okay.
I mean, I'm pretty close with the folks at Blackrock. Had no idea. All of us in the crypto community were absolutely astonished at this and excited because BlackRock's BlackRock, and for them to come out of nowhere.
An audible gasp.
Yes, it was absolutely. My wife came into the room and said, "What happened?" I'm like, "You're not going to believe this," because they came out of nowhere. Larry Fink in 2017 said the only thing Bitcoin's good for is money laundering.
Yeah.
And now, 5 years later, they decide to launch an application for a Bitcoin ETF. This is astonishing. And we knew that with BlackRock's seal of approval, with their endorsement, this would allow others to follow their lead. But no, Josh, here's the crazy thing. It wasn't BlackRock's application that was the catalyst for the SEC's approval in January. It was Grayscale's lawsuit against the SEC.
Right.
And when the court blasted Gary Gensler and said the SEC acted capriciously and arbitrarily in its rejection of all of the prior applications, that Gensler had no choice. And the fact that BlackRock had stepped up was their way of saying, there's no reason to say no to this. And so between the two events, which I think combined were the sledgehammer against the mosquito of Gensler,
the irony is that it feels safer now. It doesn't feel less. You have 9 or 10 very established ETF providers with a product in the marketplace.
Yes.
You've got arbitrage opportunities amongst professionals on price.
Yes.
You have tons of liquidity.
Yes.
The thing that they had been protecting us from turns out to have been the thing that actually makes the asset class more investable and safer for regular people who don't want to get involved with drives that are cold storage and seed phrases. I mean, it's so ironic, but it's also, you have been saying this. So
I've been in this space since 2012, and thank you for your kind comments earlier that I've been out there on this subject when no other financial advisor was. It was controversial when I said, why would somebody who's running a $200 billion RIA waste his time talking about Bitcoin? What's the point? Well, the real point is that our goal as financial advisors is to help our clients create wealth. And there is no better way, in my view, than to allocate to Bitcoin in an effort to do this. Bitcoin has been and will continue to be an outperformer. So it makes perfect sense if you believe in diversification and you believe in rebalancing and you believe in providing alpha to your clients on a risk-adjusted basis, there is no reason not to invest in Bitcoin. But here's the craziest part of it all. 5 years ago, as recently as that, Josh, one of the dominant questions that people would ask about Bitcoin was, could it go to zero? That was a real question and a legitimate debate. Nobody asks that question anymore.
no, it's unkillable.
And for that reason, to your point, Bitcoin has become de-risked. It's no longer a question of, will it go to zero? Will the government ban it? Those questions have been resolved. The question will be, what will its future price be? Will it be higher or lower?
Right.
Will it outperform? Is it a reasonable asset to add to a diversified portfolio? Those are legitimate questions and a totally different conversation than that of just a few years ago.
So now that its very existence is no longer being challenged, when FTX blew up in November of 2022, and I think the lowest it got was 15,000, and a lot of people were wondering, why isn't it a lot lower, right? It didn't die then. The ETF obviously cements its existence. So with that the existential risk of it going away is now gone.
Right.
Does that change the risk premium that investors have earned?
Yes.
What do you think reasonably? It's not going to do 1,000% in the next 3 years. Like, what do you think is a reasonable, obviously we're guessing, a reasonable expectation of forward returns?
Yeah, so as we all know, Bitcoin's profit since inception is 40 million %. That party's over. We're not going to get that again. So you're right. We have de-risked and we have eliminated a lot of the premium potential. But the party's not over yet. I did the simple arithmetic to answer this question, and my conclusion, and I can run through the arithmetic really simply for you if you would like, is that I see Bitcoin's future price at 420,000. That's a 7x increase from today's
You'll
price.
forgive me when I hear 420.
And are you memeing? Is this
like,
a meme?
Is this like, are you trying to get Elon's attention with this? We'll put it on X if you want.
Well, Michael Saylor says 5 million, so I'm not
Why
being
not
that crazy.
69,000? I mean, what? All right, where do we get 420? I want to hear it.
So it's real simple. In fact, I've got a whole 1 hour webinar on this. You can get it at DACFP.
Do it in
free.
30 seconds.
In 30 seconds. Take all the value of all the world's assets, the total value of the global stock market, bond market, real estate market, gold market, et cetera. It adds up to about $740 trillion total world assets. If the entire world, which owns all those assets, you and me and institutions and governments, et cetera, were to allocate just 1% to Bitcoin as part of a diversified portfolio, that would be inflows of $7.4 trillion. Divided by 19,400,000 Bitcoins, 420,000 per Bitcoin.
Okay.
Simple as that.
Not super
Year
outrageous.
I mean, how long? No, but
By the end of the decade, 5 years.
All right. I mean, I like that you have some framework because there are people who say things like my bear case is $1 million per coin. And you can't ask a follow-up question because they made it up.
So, I agree. And that's the problem
like
I've had is all the different folks coming up with all these different numbers, and I've never been able to understand where they get the math. And my attitude is simple asset allocation. Now, there's a lot of flaws in my analysis. I'm assuming everyone in the world allocates 1%. That ain't going to happen.
All right. So it's advisors watching this. What's your opinion? Will arbitrations or customer complaints involving the advisor use of crypto investments be riskier, or will this stuff be more heavily scrutinized than complaints involving traditional stocks or bonds?
It'll be an increased risk if you don't know anything about Bitcoin and cannot effectively articulate to the client why you're recommending it, and you cannot demonstrate to the client your due diligence process in how you arrived at it. In other words,
the way that you frame the conversation is going to be part of that risk.
That's key, because that's what the plaintiff's attorney is going to be doing. They're going to say to you as a defendant, show me your due diligence process. Show me how you evaluated these ETFs and how you chose the ones you chose. And if you can't articulate that as effectively as you can all of your other recommendations, you're going to lose that case. And that case will come when Bitcoin falls 40%, because it's going to do that again. That's just the inherent nature of this asset class. So you do need to have your act together. But aren't you supposed to do that anyway?
I was going to say, we haven't seen that yet, where somebody says, this is my IRA, my retirement account. Why did my advisor put 4% of it into an asset that got cut in half?
Right.
We haven't seen that yet because the price hasn't enabled that to happen.
And we haven't had widespread adoption by advisors to expose themselves to this.
That's true too.
So you're going to see this in the next several years, but it'll be after the next bull market, which will then be followed by the next bear market. And we know the deal, Josh. So many people are going to buy Bitcoin at the next all-time high. They're not going to buy Bitcoin until after it hits 100,000.
When an advisor asks your opinion on which ETFs, do you have any strong opinion there?
I do. I think, and keep in mind, many of these, most of them are my sponsors at my company, so I'm biased. But I do believe that you should add 1 to 3% of portfolio into these, and that you should choose 2 or 3 of them, not just one. The problem with these ETFs is that they're just Bitcoin. We all believe in diversification, but you don't get that from this. You're just getting one digital asset. It's like saying, I'm going to put all my clients' money into Google.
Well, away from Bitcoin is still a little bit of a minefield from the regulator's perspective. Just because they allowed for Bitcoin ETFs doesn't mean that they will subsequently allow for Solana ETFs. It's a little bit of a leap still.
We will likely see Ethereum ETFs by the end of the year. It'll then probably be
kicking and screaming.
Yeah, it'll be years before you get another one.
Okay.
So you're absolutely right.
Back to the ETFs. Why multiple Bitcoin ETFs?
Because there are fundamental differences in who is their custodian, who is their surveillance partner, what is the fee that they're charging. Are they a very broad-based expert in ETFs? I put Blackrock on that list, and Franklin Templeton. Or are they incredibly deep in the crypto space? And I would put Bitwise on that, along with Invesco, which is partnered with Galaxy. So I would choose a couple of these ETFs that are truly very different from each other to diversify the risk, to diversify the expertise, and give you some semblance of protection that if something goes wrong at one of these outfits, which let's face it, that's unlikely, being Fidelity versus Blackrock versus Franklin Templeton, but I think it would make sense to do that.
We're talking about Bitcoin inside a portfolio as an asset class, a legitimate asset class. Has your opinion changed over time in terms of Bitcoin needs a widespread consumer-facing application in order for it to get to the next level?
Yes, but that application is the ETF. In other words, this is the holy grail we've been waiting for.
We found the use case, and it's this.
Anybody who was interested in Bitcoin over the last decade would have discovered an incredible level of cumbersome complexity and scare, and I would say fear, in the effort to do it. Opening a Coinbase account or a MetaMask account.
Not fun.
Oh, it's not fun. It's difficult. There's no do-over. There's no help button.
Would you like some anxiety served into your wallet? Here you go.
And you alluded to it earlier, Josh. How do you manage the private key? Where do you custody? We've all seen.
No, most people don't want to do that.
Of course not. And now all of a sudden, and oh, by the way, the commissions are 3%.
Yeah.
Now all of a sudden we have the ETFs, which are as cheap as 19 basis points.
Yeah, it's insane.
Even Blackrock's is 25. Bitwise is at 20. Franklin Templeton, the cheapest. You can do this in any brokerage account in an ETF platform that we're all familiar with, where you can do rebalancing and dollar cost averaging and tax loss harvesting. It's incredibly simple and easy. It's just like another asset. How many people would like to buy gold but don't want to fuss with bullion?
Yeah.
Well, I don't have to.
GLD changed the world.
And
I agree.
And these Bitcoin ETFs have changed the world.
If you could wave a magic wand and get the public to stop repeating one misconception about digital assets, what would that one thing be? And why do you think people continue to have that misunderstanding?
Bitcoin's bad for the planet.
Okay, say more.
This is the argument that we spend.
You're somebody that cares about the environment.
Sure.
And your philanthropy related to the environment.
Absolutely right. And a lot of folks look at the amount of electricity that is consumed in Bitcoin mining, that in some cases is more, we expend more energy mining Bitcoin than the entire country of Argentina on everything it does. And this argument is created the case of Bitcoin's bad for the planet. That argument is false on a lot of reasons. Number one, more than half of Bitcoin mining is green. It uses water, solar, volcanic heat. We have to recognize that Bitcoin miners spend most of their money on electricity. They want to do it as cheaply as they possibly can. So they're turning to green energies as best as they can. And in fact, rather than being bad for the planet, it produces a lot of green jobs. This is why states from New York to Texas to Oklahoma are doing their best to recruit Bitcoin miners into their states because of the economic benefit that it creates. So we find a lot of myths. Jamie Dimon running around the country saying that Bitcoin is only used for sex trafficking. Really? I mean, we need to just dispense with the nonsense.
Traffickers hate dollars. This is very well known. Very well understood.
So we need to move past some of these old school thinking and look at the technology for what it really is.
Okay. Bitcoin tends to rally when the inflation data comes in on target or below expectations.
Yeah.
This is indisputable. Doesn't mean it's fully correlated to tech stocks, but it does mean that they are, at least right now, moving in concert with each other. They seem to have bottomed around the same time as well during the more recent bear market. Both fans and critics have remarked about this correlation with lower interest rates. And we saw another example of it this week. We got a benign inflation print on CPI. Bitcoin was rallying with semiconductors. Okay. My question is, do you think that correlation will persist? And if it does, would it make you even more bullish about the short-term outlook for Bitcoin, given that the next move from the Federal Reserve is probably an interest rate cut?
Yeah, I do think that the correlation argument is evolving. Bitcoin used to be 100% non-correlated. There was no way to predict its price movements based on what was happening in stocks, bonds, real estate, let alone interest rates and inflation rates, et cetera. That story began to change as institutional investors began to get involved, because when institutional investors are engaged, they tend to buy and sell whole massive parts of their overall portfolios because they're trying to de-risk. They're moving in and out on a more of a timing basis than long term.
Now it looks like a more classic risk asset.
Exactly right.
Okay.
So we will, I believe, see more correlation than we have in the past. And the easiest identifier is inflation, because Bitcoin is inflation proof. And so the worse inflation gets, the more persistent it is, the more we're annoyed with interest rates, the better that proves for Bitcoin.
BlackRock recently led a $47 million round into a company called Securitize, and they tokenize all sorts of different asset classes.
Right.
What do you think the future holds for this term, and what the hell does tokenization even mean?
This is a word we all have to get very comfortable in knowing. This is huge. Franklin Templeton is actually a leader in this space, and BlackRock very rapidly is becoming one as well through not only its investment in Securitize, but its release of a BIDL. It's tokenized treasury fund that it launched. Franklin Templeton actually launched the first one called Benji.
Wait, BITL?
BUIDL. Remember HODL? You know, the hodlers where we took. So they took build and they flipped the L and the D to make it BIDL instead of build.
Oh, now I'm bullish. Okay, I got it.
So what it comes down to is that there is an increasingly large school of thought that tokenization is the next iteration in the evolution of money management. We went from individual stocks, for example, to mutual funds, pools of stocks. And then mutual funds gave way to ETFs, a more efficient, lower cost, more tradable asset than the mutual fund was. The next iteration will go from ETFs to tokenized shares. And many are suggesting that by the end of the decade, ETFs won't really exist anymore. You'll buy tokens.
You jumped over custom indexes. Is that kind of like a version of tokenized? It's a tokenized S&P 500?
It's in the genre of tokenization.
It's an ETF with no wrapper and more customization.
The difference is tokenized shares exist on a blockchain.
So it's cheaper, faster.
You have instant settlement, for example. Everybody's bragging about T+1. That's nonsense. We're going to be T+0 pretty soon.
Where does that leave like DTC and the clearing mechanics that currently exist?
They're doing some of the biggest research into this.
So they're going to be part of it.
They'll be very much a part of it. And the old school thinking in crypto was that crypto was going to eliminate the financial services industry. Of course, that's nonsense. The financial services industry is instead adopting this technology. Look at JP Morgan. Despite what Jamie Dimon says, they've got their own Onyx blockchain. They're doing $1 billion a day in treasury cross-border transactions using their own blockchain. So we're going to use the blockchain technology to create tokens of what they call RWA, real world assets. Every asset you can think of. Currently, we're doing it with stocks and bonds. We're beginning to do it with real estate. St. Regis in Aspen. So
that argument makes a lot of sense to me, that if you could give liquidity to people who own a piece of real estate by tokenizing the ownership, and that way if 20 people own it and one of those 20 people would like to take their 5% stake in it and liquidate without 6 months of due diligence and lawyers, and like that always made a lot of sense to me.
And now you're going to be able to do it beyond real estate. You're going to do it with artwork and exotic assets, collectibles. You're going to be able to do it with rare wine as well as rare stamps and coins. You're going to be able to do it with any asset you can think of that has a value. You'll be able to create a tokenized version of it. The word token, you notice, like, what does it really mean? Token is just another word for share. It's a piece of an asset that I own. And due to blockchain technology, we can create, hold, and distribute those assets faster, cheaper, and safer than you can with traditional financial services methodologies.
Before we move on from this, one of the benefits of the financial system as it currently stands, yes, there are some benefits, is that if there's a mistake, we're not in a code is law type of society where, sorry, too bad. If a hacker tricks somebody and a digital asset is transferred from one party to another, that's the end.
Yeah.
There's no do-over. There's no arbiter. That's one of the things I think people like about the current financial system, is that there is a third party that can be appealed to.
We can do trade corrections.
So if we're going to go into this instant settlement world and something happens that was not supposed to happen, or there's a legitimate disagreement between parties, this is going to be challenging. You can't rewrite the blockchain every time someone's pissed off.
Let me make it even worse for you, Josh, because not only is everything you just said true, it gets even worse due to the nature of blockchain technology. What happens if you have a token created in one country, purchased by an investor in a second country, who decides to sell it to an investor in a third country, and then something goes wrong, as you pointed out? Who's got jurisdiction?
Yeah. Oh, that's interesting.
They haven't figured any of this stuff out. I'm a member of the Blockchain Global Convergence, which is a group of about 200 lawyers from around the world trying to help governments figure all this out and write laws that can work, because at the moment, none of these questions have been answered.
Do you think the tokenization is going to happen on separate platforms, or will Schwab and Fidelity adopt the technology and we won't even know that we're using the blockchain?
A lot of it will be behind the scenes. You're exactly right. Just as most ordinary investors never heard of DTCC, they don't understand who the custodian is behind the scenes. They don't understand how the trade occurred. All they know is they did a trade, and with T+1, they got their money the next day. No one's going to, even the financial advisors aren't going to know or care. But in other cases, it'll be very visible, where companies are going to use a Bitcoin blockchain or the Ethereum blockchain, or they're going to use JP Morgan's Onyx blockchain, or they'll create a proprietary blockchain that isn't open and available to everybody. It is only available to certain clients and customers. They'll create incentives and motivations for you to use their blockchain as opposed to somebody else's. It's sort of like going on a public highway versus a private toll road. A lot of this is still under development. Most of it hasn't yet been figured out.
Are there any companies in the space that you think advisors should be paying attention to, or any exciting entrepreneurs that are creating things, whether it's for advisors for their clients or an end consumer product?
There are lots. Unfortunately, I would say most of it is too early to play with. The risk is way too high. I would pay attention to the major players, which all those also, by the way, happen to be publicly traded. Franklin Templeton and Blackrock are two wonderful examples of this, where you can get engaged with a company that is going to go about this in a serious.
So watch what they're doing.
Yeah, exactly. The other way to do it is to invest in companies that are deep in this space, where you're investing in their fund. Multicoin, Galaxy are a couple of examples where.
What do you mean invest in their fund?
Well, these are companies that are doing private placements. These are private equity or hedge fund, VC funds.
So if you're accredited or a qualified purchaser, you might have the ability to see when these companies are raising money.
Exactly right.
Okay.
And they're all like everybody else. They're always raising money.
How many calls a week do you get from startups in the crypto space? They must be all over you.
Constantly.
Okay. I mean, Michael gets a lot. I'm thinking you're probably 10x.
Yeah, just a bit.
Okay. I'm not asking this in a facetious way. I'm genuinely curious about what you think. You're one of the few people that I know who has been straddling traditional finance and now the digital age really well, and keeping a level head and offering intelligent commentary, but being open-minded about things that most people were closed-minded about for a long time. I wanted to ask you, is Michael Saylor a candidate to become the Warren Buffett of crypto? And again, I'm not joking. I'm serious. Is Brian Armstrong a candidate to be thought of as the Chuck Schwab of the space? Do you see the entrepreneurs now who are in the space and taking the space seriously? Like, do you see them basically becoming lionized in the future as the digital assets world grows?
Yeah, I think it absolutely is going to occur, because crypto, and when I say crypto, I'm referring as much to the blockchain technology as to the coins and tokens that are being created through the tech, is revolutionizing how commerce is being conducted on a global scale. Not just in the financial services sector, but we're seeing industries that you would never guess that are adapting this technology. The Norwegian Seafood Association is using blockchain technology to combat forgeries of salmon. You know,
Right.
there's fake fish around the world.
Yeah.
So how do you know that your salmon really came from Norway? Well, they're tagging all the fish with a blockchain code.
Well, there is imitation crab, so you do have to watch that space.
And so
Are these people that I'm mentioning on your Mount Rushmore, or could they be? Like, let's picture yourself 10 years from now, looking back. You're going to have a list. Like, who were the people who were the giants of digital assets? I mean, are the people I named like candidates for that, or are there other people that I'm not thinking of?
They are. Michael Saylor is not going to be the king of crypto. He's going to be the king of Bitcoin. Michael is a Bitcoin maximalist. He thinks that Bitcoin is the only one that matters.
But I think he also has accumulated the most of it of any public company.
Yes, he's got, depending on the price of Bitcoin at the moment, $10 to $12 billion worth of Bitcoin, roughly 1% of the world's supply.
Okay.
So Michael is definitely one of those. There are a bunch of others.
Coinbase, pretty impressive what they've fought through and where they are now.
Brian, as the CEO of Coinbase, is definitely one of the leaders there. I would add Jenny Johnson, the CEO of Franklin Templeton, who behind the scenes has been building a lot of tokenization capability. Abby Johnson, who was, most people don't know this, she was one of the early Bitcoin miners, and Fidelity Digital Assets is—
And they never backed down.
Never backed down and never got really obnoxiously public about it either. It was a lot of behind the scenes. So there's a lot going on that I think we're going to turn around saying, I wish I'd paid more attention way back when. You still have that opportunity today.
And the standalones, the Galaxies, Novogratz, the Twins at Gemini, there's room for them too, no matter how involved traditional financial companies get. There's still going to be the crypto native companies are going to have a space.
The neat thing about all this, Josh, is that it's just software. I mean, there were only so many who could become the titans of the railroad industry or the oil industry back 100 years ago.
Because it was physical.
And it was hugely expensive and time-consuming to do. But this is just software code. Anybody can be a Bitcoin miner. Anybody can write code for a smart contract on the Ethereum platform. And this is why it's going to create the biggest opportunity in world history for mass wealth creation. One of the sessions that we've got at the conference that June 2 to 4, so very, very current, our big annual crypto conference, I've got a session that no one anywhere in crypto has ever done. The Brookings Institution and the Urban Institute in a seminar with me answering the question, what happens if Michael Saylor's right and Bitcoin goes to $5 million? What would this mean for wealth in America and around the world? What would it mean for social policy if, because of the broad availability of Bitcoin to the masses, suddenly nobody's poor anymore?
That sounds outlandish.
Of course it does.
Sounds inflationary.
Of course it does.
Yeah.
But the point is, no one in the policy arena—
Nobody's thinking about it.
Exactly.
So let me ask you this. Will Bitcoin create more wealth for the average citizen than the stock market did?
I believe it will.
Wow.
Really? I mean, we're talking about trillions of dollars.
Yes.
And you think the potential is here just in digital assets?
Yes.
All right, I gotta go buy more Bitcoin.
Get out of here. All right. So I want to talk about the event. So by the time this airs, your event will have just been recently concluded.
Right.
But people should learn more about the Digital Assets Council. Tell us about the organization that you are now, it seems, fully dedicated to, and like it seems to be the center of all of your activity these days. So tell us all about it.
I created DACFP back in 2015 to serve—
Tell people what that stands for.
The Digital Assets Council of Financial Professionals, DACFP.com, to help financial professionals understand this space, not just from technology, what is Bitcoin, what is blockchain, how does it work, but from a practice management perspective. What's the investment thesis? How do you construct a portfolio? How do you deal with regulation, taxation, compliance? How do you explain this to your clients and investors so that you can integrate this new technology, because it's the first new asset class in 170 years. The last one was the discovery of oil in the 1850s. So we've got to figure out, what does this mean? What's the impact? How do I include it? Should I? And if so, how and how much? And that's all we do. We don't manage money. We're not running funds. We are strictly education. We created—
How many advisors are getting your messages?
Oh, we reach— through my daily podcast, it's in the top 1% of all podcasts. We have hundreds of thousands of followers. We've got, through our CBDA, the Certified in Blockchain and Digital Assets Professional Designation listed by FINRA, we have thousands of financial professionals from 37 countries who have gone through the course.
Wow.
It's in 9 languages now. It's an online self-study program. You can binge it in a weekend. The average is 10 days to complete it. And it's all designed to get you up to speed. To answer the question you asked earlier, what is tokenization? Why should I care? We need to be focused on the development of these technologies for the future, because it's going to have an impact on your business. And selfishly, as a financial advisor, this represents the greatest business building opportunity of the decade, because most advisors don't know anything about it. Even fewer are engaging with clients about it. And yet 20% of US households own it. So you have clients who own this. They want your advice. They want to do it simpler, easier, faster, and cheaper and safer. You can show them how to do that. And that means more clients for you, more AUM for you, more referrals for you if you'll simply embrace rather than ignore this new tech.
Rick, this has been amazing. When we think of this subject, you're the first name that comes to mind, and we so appreciate you making some time and bringing us up to speed with what's been going on.
Thank you, Josh. And at that conference you mentioned, which by the time you're hearing this, we've just concluded, the entire conference is now online at dacfp.com. You can watch all the sessions that you didn't get to see in Austin.
That's pretty awesome that you're giving that away. Okay, dacfp.com. For more from Rick Edelman, follow the podcast. You're on LinkedIn as well. You're everywhere.
I try to keep up with you, Josh.
All right, fair enough. Thank you so much, Rick. From Michael and I and everyone here at The Unlock, that'll be it for today. Hope you appreciated this program. And if you did, make sure to leave us a rating and review. We will talk to you soon.